Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me for this episode is Mark Abssy, who is the head of indexing at Tematica Research. And we're going to discuss some ETFs that can help you build better portfolios during a pandemic. Mark's second time on the podcast. Thanks for coming on, Mark.
Well, thanks for having me, Jay. It's always a pleasure to be here.
All right, so let's start with this. Where in the country are you located?
I live in New Jersey, so I'm on the East Coast, and luckily not in the direct epicenter of all the COVID action in Manhattan, but close enough.
All right, so it is Monday, June 29th. Tell me, what did you notice this weekend in your part of the world as it relates to people and their attitudes towards the pandemic?
I've seen more people, honestly, just getting out and about. A few friends and of families heading down to the beach. People starting to retreat and escape to their beach houses, or their, as they say up here, heading down the shore. And honestly, just people saying, you know what, home is good and this is fine, but I've been cocooned now for a couple months and I feel okay. So I'm going to trust that other people have been doing the right thing, and let's see what happens, right? So, not that I necessarily advocate that, but that's just what I've been seeing.
All right. So if you're watching this broadcast live on Twitter, YouTube, Facebook, or LinkedIn, feel free to ask questions in the comments. Mark is an expert at index and product creation, and we're going to talk about some of the products that are in the marketplace that could give you an opportunity to provide some protection and potential upside given the pandemic. So today we are going to use some charts from my new friends at ETF Action. ETF Action is a platform that will help you analyze ETFs and look for opportunities not only in the ETF space, but look at the individual holdings. It's a really cool platform. I suggest signing up for a free trial at etfaction.com. I do not have a commercial relationship with them. I've just been playing around with the platform, and I think you will find it interesting. Mark, what is the first ETF you want to talk about today?
Well, as we were talking earlier, there are 3 new products that launched in the last month. And, why don't we start with Direction's Work From Home ETF, which is, I believe the ticker is WFH. Mm-hmm.
Okay.
So, this is a product, again, that launched recently. Its total expense ratio is about 45 basis points. And what they're looking to do is, it's not so much specifically about pandemics or COVID, but because of what's happened with the pandemic, a lot of trends that have been emerging over the last few years have been accelerated. And certainly work from home is one of them. Now, when I take a look at this product and I look at the holdings and I kind of do a little bit of analysis, the way that the index is set up is there's 4 buckets that they are pulling stocks from. One is cybersecurity, one is remote communication, one is cloud computing, and then the last one they call it online project management. Now, there have been cybersecurity products around since 2014. There's been cloud computing products around since 2012. And what I find interesting about this is that the portfolio only has 40 names in it. And what the index provider purports to do is to say, we're gonna pick the best names out of these various buckets. And it's an interesting premise. And like I said, on the face of it, it kind of makes sense. But what's interesting again is that when you look at what these names are doing, the index had a rebalance in March, and the index rebalances to equal weighted, which means that each position is going to be 2.5%, given that there's 40 names. And since March, really, we've only seen about 10 or 12 of those names, appreciate, and all the other names are either flat or off a fair bit. So it's the idea, I think, is good. I just don't know how good a job that they are at selecting these names, or frankly, predicting the future, which, as you know, is hard.
We
It's a
don't do
pretty hard
that,
task.
Mark. We don't predict the
Exactly,
future.
exactly. So, again, an interesting product. I kind of wish that they would blow it out a little in terms of holdings. They are making some concentrated bets, and in doing that, of course, because they're not a research shop, it's going to be very difficult for them to really kind of hone in on the winners, right?
Right. Selective's a great firm.
Yep.
So what I notice here looking at the ETF action side is that they say stocks are selected using proprietary natural language processing algorithm. Mark, what does that mean to you?
It could be as simple as a word search, quite frankly. A lot of the AI stuff that I've been reading about, and conferences that I had gone to prior to COVID, a lot of people talked about natural language processing, and at the end of the day, those platforms and those processes really are only as good as kind of the people who are building the mousetrap, right? And effectively, what it is, it's a slightly more sophisticated search engine. And instead of searching for one word, maybe you're searching for a cluster of words, and you give that a score.
Mm-hmm.
So that language coming from an index provider, selective or otherwise, to me seems a little squishy.
Yeah.
But at its most basic, all that AI stuff and all the natural language processing is basically kind of a glorified word search, right?
Well, Mark, let's give them a little bit of a break. The fund literally launched 4 days ago. I
Sure,
like
sure.
I like the expense ratio at 45 basis
Yeah,
points for
yeah.
something that is targeting in, and I
Hmm.
like the fact that it's rules based because I think that is the only
Yes.
way you can invest in anything.
Yeah, yeah, yeah.
Let's move on to the next one.
All right. The next one, let's look at VIRS.
Oh,
And this is interesting. This is the Pacer Biothreat Strategy ETF. It's a little more expensive. It's about 70 basis points. And while the ticker would indicate that it's focused on the biotech side of things, really what the goal is here is taking advantage, if you wish, of uh, names that are associated with kind of the preparation and response to pandemic threats. So while there are a lot of biotech names in here, there are also names like 3M, Netflix, NVIDIA, Home Depot, right? Citrix Systems, Campbell Soup, Clorox, right?
mhm.
So,
I'm sorry, you said Netflix?
yes.
Okay.
So, and again, it's this idea that, in the sense of a rising tide lifting all boats, when you think about a pandemic, there certainly is an imperative on the biotech side and on the healthcare side. But we also look at some of the names that have been outperforming in this pandemic, and certainly, Clorox was one of those names. I don't think it had a down day from February 19th till recently, you
Mhm.
know. And so what they're looking to do here is really to try and take advantage, almost in a holistic sense, as to, okay, what happens in the economy when an event like this happens. Now, what's interesting to me is that this product actually had been in development for a couple of years. And it was only during this pandemic that the folks at Pacer decided that now was the time to launch it.
So I'm a big fan of Pacer. I
Yeah.
love some of their products that are driven by the 200-day moving average, and
Hmm.
they've really helped advisors lower the cost of having
Yeah.
systematic trend following in their portfolio. An interesting new product from them. Again, it's not very old, and clearly there's some thought process behind that was in the works before there was
Yeah.
even a
Yes.
pandemic. Yep.
Yeah.
Why don't we move on to Germ?
Yes. Germ, our friends at ETFMG, ETF Managers Group. Now, Germ, in as much as the Pacer product tries to look at the healthcare and biotech side and kind of the broader economy, Germ really focuses in on the biotech side. And it's really, even when you look at the name of it, it's the ETFMG Treatments, Testing, and Advancements ETF. Also a little pricey at 68 basis points. But, again, when you look at what's happening here, there's a lot of well-known names in here, right? There's, Johnny John and Merck and Pfizer and Abbott and those names that you would expect to be in here. Now, what this portfolio also does is it really kind of spices things up toward the lower end of the cap range. And so when you look through the portfolio, there are a lot of names in here that, quite frankly, I've never even heard of. And when you look at their market caps, I mean, I think the smallest name I have in here is something like $109 million, right? Now, again, this was a product that was spun up in response to the pandemic, and clearly there are names in here that have benefited. And in fact, if you look at 90-day value traded figures and compare recent figures to those same figures in the end of last year in 12/31, we see some of these names blowing up. We see some of these dollar value figures going up 3,000%. In a couple of cases, 23,000%, 46,000% for Inovio Pharma, right? There's another name in here, Co-Diagnostics. Its ADV is up 230,000% since January. Now, what that says to me is that clearly there's opportunity in these names, and the market is either just finding out about them or they're putting out good news about everything. But what I worry about it is that are there still legs in these names, right? And you look at some of the returns, and again, some of them have popped a lot up until the fund launch, and then since the fund launch, things have kind of come off a little. So again, it's a good idea. I think what this fund tries to do is have a solid base of established biotech, and then in some sense is almost kind of picking up some scratch tickets and seeing what happens in the lower cap range, right? So,
did you say scratch tickets?
I did.
Oh, that's great. All right, so let me put you on the spot like I'd like to do to your partner, Chris Versace.
Sure.
So we've walked through 3 potential ETFs that a financial advisor could add to their portfolio to help enhance returns or reduce risks in this environment. If you could only choose one of these 3 ETFs, which one would you choose and why?
Okay. I will go through just very, very quickly each of them. But so Germ is a Mad Money ETF. If you want to take a flyer and kind of see what happens, a little allocation there. The one that I think would gravitate to would be the work from home one. And the main reason why, as Chris would say, you're really looking at themes that have strong tailwinds, right? Chris, we always at Tematica talk about headwinds and tailwinds. Work from home, WFH, really is supported by a number of tailwinds, right? And while the individual name picking, might not be always on target, there's plenty of studies that indicate it's more about allocation and exposure than it is about weighting. You would just need exposure to those names. That'll do more for your overall portfolio than saying I picked the right name within that exposure, right? So.
All right. So work from home, it's time stamped June 29th, 2020. We'll come back and revisit it. So, and I didn't tell you I was going to put you on the spot like that. That threw you off a little bit?
That's okay. That's okay.
All right. Let's wrap up with an ETF that you wanted to bring to viewers' attention. And specifically, it's for folks that are looking at fixed income exposure, long fixed income exposure. Walk us through what you're looking at.
So this is the ticker is ZROS. It's a PIMCO 25 plus year zero coupon treasury ETF. And I just thought that it was interesting because in as much as people are looking for, what's going to pop on the equity side, where the opportunities there, this is a product that has, in kind of more general terms, been going a little bananas. And the reason why is because with rates as low as they are, right, this product has a very long duration exposure, right? And if you remember from your bonds 101 class, when rates go down, right, values go up in bonds. And so you've had this depressed rates environment, and you have this other product, zeros, which has very long duration exposure, and it's just kind of a match made in heaven. Now what's also interesting about this is that given the outlook for a rise in rates, where this trend starts to reverse, I mean, I don't know that that's going to be happening anytime soon over here anyway. And again, the only thing that I wonder about is, are there still legs in this, right? And does the potential for the Fed to go negative or even lower kind of create more problems than it would in terms of capital appreciation in this product? Right. But I just thought that it was something that's interesting, and kind of just an example of how the fixed income side. People always think about fixed income, they're clipping coupons or clipping coupons. There can be some pretty heavy action on the fixed income side, right?
Oh yeah. So for the first 3 ETFs we spoke about, there wasn't a lot of utility on this ETF action platform because they're newer ETFs and the data's not there. As live viewers can see, you can dig into the technical analysis of securities in a very crisp way, get instant access to data that you would typically look for on these portfolios or on these ETFs, risk statistics, etc. So if you'd like a free trial of ETF Action, please head over to etfaction.com. Again, I don't have a commercial relationship with them. I just think it's a pretty neat tool. Mark, I really do appreciate you coming on and sharing your thoughts on some ETFs that can help advisors in this marketplace.
Well, thanks again. Pleasure to be here, and hoping that you'll have me back.